Okay, good morning, everybody. I'm Jerry Hafer. I represent the AMAC Foundation. And let me take a couple of minutes and talk to you about who AMAC is. Have any of you ever heard of AMAC? Let me ask. Excellent, excellent. The growing AMAC family consists of AMAC Incorporated. AMAC is the fastest growing conservative support organization in the country. AMAC's mission is to represent seniors in Washington. And they do that basically through a subsidiary called AMAC Action. AMAC Action basically translates senior member interests into direction for legislators. And they basically establish relationships with legislators to make sure that senior issues are being represented. So that's pretty much what AMAC does. AMAC is a membership organization. The AMAC Foundation is a 501c3 registered public benefit corporation. We are a nonprofit headquartered here in the state of Florida. And our mission, I'll read it really quickly, it's very simple. Our tagline mission is supporting and educating America's seniors. That's what we do. And the full mission is to help protect and ensure the financial security, health, and social lives of current and future mature Americans, and to help Americans navigate the bewildering array of decisions they need to make. And that's one of the reasons you're here today, so we can talk to you about the bewildering array of decisions. Social Security can tend to be very complex, so we're going to cover a lot of material today. So how does the foundation cover its mission? Well, we do it in a couple of different ways. First of all, we conduct public seminars, like this one we're doing today, and we we do seminars usually up until the pandemic hit. We were doing 2 to 3 every month on subjects of interest to seniors, things like Medicare fraud, financial fraud, a lot of benefit-related seminars, and we were doing, as I said, 2 to 3 of those every month. And of course, when the pandemic hit, we had to stop that. And we're looking forward to resuming that this year on a more aggressive basis. This is the first one we've done as a public seminar in over a year. So we're happy to get back into the swing. Second thing we do is we issue publications on matters affecting seniors. For example, we do publications on Social Security. We published this book last year, which basically is titled What's So Hard About Social Security? And the book explains what's so hard about Social Security. And this is a book that's available for sale from the foundation. But we do a lot of other publications also. We publish a monthly newsletter. We publish a weekly blog on our foundation website, which I'll talk about. And we publish a lot of informational articles. We have a collection of them out on the table, and they appear in the AMAC magazine frequently, articles about Social Security. So that's the publications that we do. We also operate 2 focused topical websites. One is the socialsecurity.report.org, and that's a site that focuses totally on Social Security. And we update that 5 days a week with breaking news about Social Security, and there's a lot of background information about Social Security that appears on that site. It's a very heavily accessed site, provides a lot of information to people about Social Security and retirement as well. And MedicareReport.org is similar, but it's focused on Medicare and healthcare. So those are the 2 topical websites, that we operate. And last, certainly not least, it's our flagship program is our Social Security Advisory Service, and we'll talk a lot about that as we go through the morning. But that's something that we started, we're in our 5th year now, and I'll talk a little bit more about the history on that as we get into this. So that's how we carry out our mission in the foundation. Talking about our primary website, amacfoundation.org. I would encourage you to take a look at that. A lot of information on there. We publish, whenever we schedule an event, we publish information about it on the events page. We have a videos page and an audios page. It has a lot of recordings of seminars like this that we've done. It's just a whole host of information. The weekly blog that I mentioned is on our news and interesting information page. Every Monday morning at 9 o'clock, there's a new blog post that shows up. So I would encourage you to take a look at that site. It gives you background on the foundation, who our board members are, and everything about the foundation. And also, there's a page called Services that tells you how to access the Social Security Advisory Service, which we'll go into a little bit more. Our advisory service, we are extremely proud of it. We started it in 2016, and we took a while cautiously to get it off the ground. We only answered 300 inquiries that first year. And then in 2017, we began to promote it a little bit more, and you can see how the growth has developed over the years. And so far, we've handled over 15,000 inquiries. We're handling right now over 600 every month. So it's become a very, very busy service. And we handle inquiries through phone calls, emails, and walk-ins to our office. An inquiry can take us anywhere from 5 minutes, 10 minutes to 5 hours or 10 hours. It just depends on how complex the situation is. But that graph gives you a good example of how we've grown since 2016, and we're continuing to grow. Our volume of 600 or so a month, we think is going to continue, and actually I think it's going to grow substantially. And I project that by the end of 2021, we will have crossed the 20,000 mark in inquiries that we handle. So it's a very busy service. In 2017, we began to really market the service, and we did it primarily through a service called Ask Rusty. And I'm proud to tell you that Ask Rusty is actually the guy in the middle there, and I'll introduce him in a minute. But every week we publish a Social Security question that we've actually received and a very detailed explanation of how we answered that question. And that gets published to over 7,000 media outlets across the country. And we know that hundreds of them pick it up. It's newspapers, blogs, online services, and we know that it's getting out there. So it's part of what's helped us grow and helped us get known. We also just recently started doing audio versions of that, where we actually record an audio version of the document, and that's released to radio stations for plugging into their daily programming. So all of this is how we're advancing the foundation brand, and it's what's causing our growth, and it's a good thing. It's a good thing. The audio files, incidentally, are a part of the audio page on the foundation website, so they're available for access. We published 2 years ago a compendium of the first 80 or so questions that we answered. That was the first edition, and the book that I just mentioned is our second edition. So we're probably going to continue updating that as time goes on. Well, that's a pretty quick overview of AMAC and the foundation. Now, here's what we're going to talk about today. A lot of topics. It seems like you're going to be here all day, but not really. We'll be going through some of them fairly quickly. But we're going to talk about what's new for 2021, the new limits. We're going to talk about the basic stuff, when to file, I guess I would call it a disappointing situation of taxation of benefits. We get a lot of questions about that. We're going to talk about disability basics, spousal benefits and surviving spouse benefits. We're going to talk about people that file for Social Security but continue to work, what the implications are for that, and what the rules are on that. We're going to talk about this thing called COLA, the annual cost of living adjustment. And then we're going to get into something called windfall elimination provision and government pension offset. I don't think we're going to get into it too detail, but we just want to introduce it for people that are affected by it. So we'll be talking about what they are and how they impact people. And then finally, we'll close with Medicare and Social Security, how they combine, how they interact. So that's pretty much the agenda for today. And it seems like a lot of material, and it is, but we're going to go through it kind of carefully. So with that, let's get into it. And I have to introduce my colleagues before I bring them up here. And let me start with Sharon Kletchka. Sharon has a background in accounting and tax preparation extending more than 20 years. She joined AMAC as a member service representative in 2014. She loves working with the public and being able to help people, and that's so important in the job that she does for the foundation. She loves to help people. Sharon's duties at the foundation are focused on assisting members that have questions on Social Security. In addition, Sharon assists with the foundation's financial records, and she's actually our bookkeeper, and she coordinates the production of reference materials on Social Security. She is a dually accredited National Social Security Advisor, having achieved credentials from NSSA, which is the National Social Security Association, and the National Association of Registered Social Security Analysts, NARSSA. So she's our only dual accredited advisor that we have. Arlene Sharp, and would you take a bow, Sharon? So that's Sharon. Arlene Sharp. Arlene's background features nearly 20 years of experience in customer service and administrative support. This experience, coupled with her work as Director of Merchant Services for AMAC Small Business Solutions and Quality Control Coordinator for Member Services, gives her a strong foundation for the research that she does, for the problem solving, and for the communication tasks that we give her in handling incoming inquiries. She's excited about the challenges she has in her position. And I can tell you, I sit right next to her in the office, and I listen to her handle inquiries day in and day out. And her skills are tremendous in customer services, and we appreciate that very much. So Arlene, would you take a bow? Eileen Cook. Eileen Cook has a career that features over 30 years of experience in healthcare, ranging from clinical side to the home health care industry to financial side in 2 leading nonprofit hospital systems. And it includes a tour of duty as a pricing specialist negotiator at a Blue Cross Blue Shield health insurance company. Eileen knows her way around healthcare, believe me. After working in a multi-hospital healthcare system, she joined AMAC Healthcare Research as a AMAC Healthcare Research Analyst, and she also serves as administrative assistant for the AMAC Foundation. And that includes editorial maintenance of the Foundation's Medicare Report website that I mentioned earlier. And that's the MedicareReport.org, and also editorial work on the SocialSecurityReport.org. And Eileen, too, is an NSSA accredited Social Security advisor. I didn't mention that with Arlene. Arlene is also an accredited advisor. So Eileen? Ken Barron. Ken brings to our advisory team a strong working knowledge of Social Security's organization and operation. As a 34-year SSA professional, he has extensive experience in dealing with questions and concerns from the public about Social Security. Ken's practical approach to interpreting the public's information needs makes him an effective communicator for folks trying to decipher the complexities of this vital senior program. His in-depth experience in dealing with the public fits well with the resources on our team, and his ability to convey Social Security's rules and regulations in clear and understandable terms is an invaluable addition to our advisory service. As an NSSA accredited advisor, Ken helps us deal with the growing volume of inquiries our team handles. He's a resident of North Fort Myers, Florida, and he escapes to the Northeast United States for the summer months. Ken is accredited by the National Social Security Association, NSSA. Ken. Russ Glure, also known as Ask Rusty around our office. Russ's professional career spans over 50 years with major organizations, including Pan American World Airways in New York City in their communication research and development area, American Express Company, where he served as management information systems, in the management information systems for the travel division, and IBM, where he focused on sales and engineering management and project management, and ultimately was appointed executive responsible for IBM Global Services Worldwide Quality Assurance Program. Russ retired from IBM in 2003 and enjoyed 10 years of retirement before joining the AMAC organization and eventually the AMAC Foundation, where, as an NSSA accredited Social Security advisor, he provides assistance to seniors approaching their Social Security benefits enrollment decision. Russ. Yeah. Now, I won't say much about me. I concluded a 30-year career in the utility industry back in the 1990s. I retired as information technology director for a major utility up in Pennsylvania, New Jersey. I then embarked on a second career as a business manager for a regional law firm in Pennsylvania. Did that for about 5 years. Got tired of winter, frankly. Moved to Florida in 2003. And then I embarked on a third career as an adjunct instructor and consultant for Lake Sumter State College and the College of Central Florida. Did that for 7 or 8 years. Then in 2012, embarked on a fourth career with AMAC, providing consulting services for AMAC and then eventually for the AMAC Foundation. So that's a quick review of me. Yeah, I too am an accredited advisor. It's part of the the requisites that we have for being an advisor. And so this is our entire. What you see before you here is the entire AMAC Foundation Social Security Advisory staff. These are my colleagues, and I'm proud of them. So, okay. So moving into our presentation, I'm going to ask Sharon to spend a little bit of time talking to us about what's new in 2021.
Well, I'm sure all of you are too well aware that the cost of living increase for 2021 was only 1.3%. Some of the other increases due to the national average wage index was that the maximum taxable earnings this year are $142,800. That is the amount you pay Social Security taxes on. That is the amount that your Social Security benefit is based on. The maximum Social Security benefit for someone reaching their full retirement age is $3,148. You need $1,470 per quarter to qualify for the 40 retirement credits. The earnings test for people. The earnings test for people under their full retirement age this year, you have to remain under 18,960. If you're turning your full retirement age this year, you can earn as much as 50,520. Now, these will be covered in further detail during the presentation. And these are some types of benefits that people apply for. A lot of people think only the worker, the retiree, qualifies for benefits. Well, the workers must be at least 62, have their 40 quarters, but also their spouses and ex-spouses, if married 10 years, also qualify. This includes spouses that maybe never worked. They're covered under the worker's Social Security record. Then the survivors of deceased retirees, you have your current and ex-spouses become eligible at 60 or 50 if disabled. Dependent children under 18 or 19 if still in high school. And dependent parents. Dependent parents are parents that as they get older, depend on their children for their support should that child pass away, and that they have a higher Social Security benefit available to their surviving parent. That parent can actually collect on their record. And for disabled workers with enough quarters, can collect disability benefits. Now, this varies with age. I mean, 60 plus, you have to have your 40 quarters. Younger workers, it's calculated totally different. And disabled adult children, if their disability began before the age of 22, they're still considered eligible for child benefits, and they become eligible under their parents' Social Security record. If one of those parents begin benefits, they not only become eligible under the parents' record, you're actually required to sign them up for Social Security when you apply for benefits if they are receiving SSI.
Okay, and as Sharon said, we'll be talking about these in a lot more detail as we go through the next couple of slides. Now I'd like to move into what I consider one of the more fascinating aspects of your Social Security benefits, and I think it's something that we find very, very few people really have an understanding of how that benefit figure that they get from Social Security is actually calculated. And we think it's an important thing to know. So I'm going to ask Russ to come up and talk about that.
Yeah, I gotta move around. Yeah, I like to move around. Yeah, so this, I don't need that, Jerry. I got that thing. I'm equipped, fully equipped. Yeah, I'm wired. A lot of coffee this morning. So this is one of the things that is so often misunderstood. I would say most of the people, most being maybe half of the people that we speak to and that we deal with every day, have a misconception of how benefits are calculated. For the most part, people think, well, kind of like old pension systems, that they're based on your last 5 years or 3 years or your last 10 years of your earnings, your working years, and that's not at all how it's done. It actually looks at your lifetime benefits. What they do is they take your entire lifetime earnings history, and for the years before the year you turn 60, they adjust that for inflation. And then they take the 35 highest earning years that you have and add those up and divide by 420, which results in something called your average indexed monthly earnings, or we call it AIM. And your AIM is then used, it's applied to a formula that determines your Social Security benefit. Actually, it's called your PIA, your primary insurance amount. That primary insurance amount is the amount that you get, or you would get, if you filed for your benefits to start in the month that you turned your full retirement age. And we'll get in later on what is a full retirement age. So that PIA becomes the basis of everything else that's done. If you get it at your full retirement age, you will get 100% of your primary insurance amount. If you take it earlier, you'll get less. If you wait longer, you'll get more. Now the formula is this one here. The AIM that I mentioned is broken into 3 parts, which Social Security calls bend points. And then they take a percentage of each of the 3 parts. The first, and these numbers are adjusted by year, but the first for 2021, the first $996 of your AIM, they take 90% of that. The next amount of money from $996 to $6,002, they take 32% of it. And anything over $6,002, they take 15%. So in this example that I have before you, an AIM of $6,050 will result in this computation. So your $6,050 AIM will result in a $2,505 Social Security benefit amount, or PIA. So I think that's probably that chart.
Yeah, I just want to add one comment. For those For those people that don't understand that Social Security is actually means tested, this is an example of one way it is means tested. You can see that the higher the income level in your AIM, the less of a benefit calculation you're going to get for that extra income.
Right, you get a smaller percentage with a higher amount.
That's an example of the progressive design of Social Security.
Right.
Okay.
Okay, and I mentioned the full retirement age, and a lot of people, you'd be amazed at how many people think the full retirement age is actually 65. Pretty common because everybody knows that Medicare, you become eligible for Medicare at age 65. Many people think you become eligible for Medicare, you need to go on Social Security, which is absolutely incorrect. Here's how your full retirement age is calculated. It depends entirely on the year you were born. So if you were born before 1938, it's 65. If you were born between 38 and 42, it's 65 plus 2 months for every year. I was going to tell you what my full retirement age is, but then you'd be able to calculate my age. Or I'm going to tell you what year I was born. But your full retirement age for most people retiring today is between 66 and 67. If you were born before 1955, it's 66. If you were born in 1960 or later, it's 67. And if you were born in any of the years in between, it's 66 plus 2 months for each additional year. Pretty simple. Now, there's been a lot of discussion about whether or not the full retirement age is going to go up because, as we probably all know, there's a Social Security solvency issue that's talked about in the papers quite often. That's indeed a possibility. But if that were to happen, I would say I'm pretty much assured that it wouldn't affect anyone in this room. It would affect people who are not yet eligible for Social Security, and probably not people who are eligible but are not yet collecting. So if they raise the full retirement age and you hear they're going to raise the full retirement age, it's really not going to affect you, so don't get upset about it. So what's the best time to collect Social Security? Well, don't interpret this chart to mean that the best time is any one of those bars up there, because this chart essentially reflects when people are claiming Social Security. It's not necessarily when the best time for them to claim Social Security is. As you can see, by far the majority of people claim it at 62. 62, so many people say, you know what, I'm going to take it. And in fact, in the book, it says that's how the title of the book came about, because someone said to me, what's so hard about Social Security? You turn 62 and you take it. It's a lot more difficult than that. But an attitude like that is why most people claim at 62. Then you can see the percentage of people who claim at the in-between ages, between 62 and their full retirement age. You can see that there's some percentage of people that do in there. Full retirement age is the next most popular. Strangely, one of the least popular is age 70. And age 70 is when you get your maximum benefit. So, of course, many people can't wait that long. Okay. This shows you the effect of starting at age 62 versus starting at your full retirement age versus waiting until 70. And you can see that graph. If your full retirement age is 66, which is reflected by the blue bars, you can see that age 62, you get a little over $1,500. If your full retirement, your PIA is $2,000, you get a little bit over $1,500. You get that full $2,000 at your full retirement age, but at age 70, you get 32% more. Age 67 full retirement age is kind of the same thing. The red bars you can see you get a little bit less if your FRA is 67, but it goes up in a similar manner to age 70. So the way to maximize benefits is really age 70. There are consequences if you claim back here. We'll get into those that have to do with whether you're working or not. Okay. So what is the best age to claim? A lot of people ask, well, when am I going to break even? I think if you were to ask that question at Social Security, it would say it doesn't matter when you claim because you're going to get the same amount of money in any case. on the philosophy that if you claim earlier, you'll get smaller benefits, but you'll get more of them. If you wait later, you'll get fewer benefits, but they'll be larger, thinking that they'll both average out. But the difference is, it depends on how long you live. So if you start benefits at your full retirement age instead of age 62, you're going to break even at age 78. If you claim your benefits at age 70 instead of your full retirement age, you're going to break even at age 83. And if you claim your benefits at age 70 instead of age 62, you're going to break even by age 81. Now, what do I mean by break even? It means that you will have collected the same amount of money at either of those. So if you claim at 62 instead of 70, you're going to have collected the same amount of money at age 83. Or is that 81? 83. So it's a pretty easy mathematical formula to do that. But keep in mind, it again reflects that the longer you wait, the higher your benefit's going to be.
Okay. Next area I want to talk about is the return on investment. A lot of people have the opinion that they pay into Social Security all their working lives and they're never going to get back what they paid. I'd like to ask Ken to come up and talk a little bit about that. Okay. Was that Russ?
I'm going to ask Russ.
Okay. All right.
Oh, thank you.
But it's a myth. It's a myth that we deal with.
It's a myth, and actually, it's in the book also. But it's a pretty consistent myth, because I can't tell you how many times I've heard people say, you know what, I'm never going to live long enough to get back everything that I've contributed to Social Security. That is actually a myth, because I'll just use this chart to show you. The blue bars here represent the amount of money that was paid, the amount of taxes that were paid, FICA taxes, in 4 different scenarios. The first one, well, Sharon mentioned the National Average Wage Index before. That's a number that changes every year, but this first set of bars here says if someone made 50% of the National Average Wage Index, this is how much Social Security tax they would pay, and this is how much benefits they would receive on average. This one is 100% of the National Average Wage Index. This one is 150% of the National Wage Index. And this one moves off and says, what if someone paid the maximum amount of Social Security tax that was possible for them to pay? And that is this bar here. So what you can see is someone who is a lower earner earns this much, but they get much, much more back in Social Security benefits. Same here, much, much more. You pay more taxes here, you pay more taxes here, but you're gaining more benefits. And what it all boils down to is reflected in this chart, in those 4 different scenarios, that if you start collecting at your full retirement age, and assuming a 2% COLA increase each year, that low income or that low earning worker would break even at about 68 if they collected at 66. So a little over 3 years. This second one, which is 100% of the National Wage Index, would break even at 69 and a few months. This next one, which is 150% of the National Wage Index, breaks even at age 70 in a few months. And the one that paid the maximum amount would break even at 71 in a couple of months. So this chart proves, and this was done by a colleague of ours, it was a very, very detailed study, but it proves that you get back. Yeah, I mean, some people don't. I mean, realistically, you may not live that long, right? But most people get back much more in benefits than they contribute in Social Security taxes. So.
Okay, now, I mentioned earlier that one of the things we're going to talk about is the situation where people elect to draw benefits but continue to work. So I'm going to ask Ken to talk about that next. Take it away.
Thank you, Jerry. First thing, I have to say that yesterday was the first time that I met my colleagues face to face, with the exception of Jerry, and I'm so proud to be part of this group. They are so professional. They help so many people all over the world, really. And just to piggyback a little bit of information that Russ was sharing with you about, will I ever get back what I put into this? Well, I did, because I sat behind a desk for 27 years with Social Security doing retirement claims. I did my own little survey. I actually computed, because I had all your records in front of me, what you paid in, what you're going to receive from Social Security, and how many years it's going to take for you to actually recover your taxes that you paid in, Social Security taxes. And almost every single time, it was always just about that 3-year period. Rarely did it go over, under. It didn't take very long. And I always had folks say, oh, I'll never live to see everything that I put into it. Well, you saw the graph that Russ was sharing with you. If first of all, you have to have the ability to think ahead at a younger age and say, okay, I'm going to put that money aside. I'm going to bank all of that. Because I used to hear a lot of times, too, that what would have happened if I would have taken those taxes and, taken care of that with a financial advisor or whatever? Well, if you have the mindset to be able to do it, but I can tell you for sure, there's a lot of people in this country that would not do it, okay? So where does that leave them at retirement age? Probably next to nothing. So Social Security is so, so important to the folks of this country. One of the topics that's so unknown to a lot of people is, can I receive benefits? Can I sign up before my full retirement age, either because I have to or I want to, and still work? And the answer is yes. Now, Uncle Joe at that 4th of July picnic, okay, who becomes the Social Security guru of the family, is always putting out some advice to all the members of the family, okay? And his advice is always changing from member to member. And we hear, Social Security hears all these stories, and I could write a book about them, about people coming in 2 years after the fact where they could have applied for benefits, but they didn't, because they were still working, and even part-time. So the answer to the question, can I collect before my full retirement age and still work, is yes. But Social Security has limitations, and it's called the Social Security Earnings Test. And how do they formulate this test, so to speak? It's by the amount of Social Security income that you earn during the course of a year. So one thing to keep in mind, all right, as I explained this, at full retirement age, and you've heard what full retirement age is, it's determined by the year of your birth. The month you turn full retirement age, you can earn anything you want and collect your Social Security if you decide to. You apply, you say, yes, I want to start collecting. So you can do that. But for the calendar year prior to full retirement age, there is a limit. And this keeps going up a little bit each year. This year for 2021, Social Security has set that limit at $18,960. If it's wages, okay, take a look at your W-2 form. It's whatever amount of income you have on your W-2 form that shows Social Security tax. If you're self-employed, then it's your net profit that you end up by paying Social Security taxes on, or a combination of both, all right? You can earn up to $18,960 without Social Security benefits being forfeiting some of those benefits. Now, don't get this mixed up with taxation of Social Security. That's going to be covered a little later. This is not taxation. This is a determination of whether you qualify as being sort of retired or fully retired, okay? This is the test that Social Security uses. So if you decide you're going to stop working, you're going to earn less than $18,960, and you want to file for your benefits and receive them, you're safe. If you plan on going from full-time to part-time work, your part-time work is going to be less than $18,960, you're safe, okay? So you can go ahead if you want to. You don't have to. I've talked with folks who've come into the office to find out, hey, look, I just turned 60, I took an early out from work, that's it, I'm retired. All right? Will I have to take my Social Security at 62? No, you don't. You take it when you feel like it. Or if financially you have to at that point, then that's a different story, okay? First year of retirement, the first year of retirement, if you're still working and you plan on stopping work at some point in time, there's also, now, the earnings test is based on a calendar year, January through December. And you hear a lot about federal government operating on fiscal, okay, maybe October through September. Social Security's earnings test is January through December, okay? Keep that in mind. In the first year, if you decide I'm going to work through the end of June, July 1st on, I'm done working. But let's say that you earn over the $18,960 by the end of June. Well, whatever income you earned prior to July still counts towards that $18,960. That's not fair, is it? Because I wasn't retired. I was still working. Now I'm being penalized for that. Well, Social Security saw that. So they decided, let's create the monthly earnings test. And as you can see right here, see that $1,580 a month? $1,580. If, let's say the same example I was using, by the end of July, you're done working, but you've earned $50,000 by then. I wish I would have had a job like that, but it never did produce. Now, starting with July 1st, your income is less than $1,580 per month. Regardless of what you earned prior to those months, you can still collect your Social Security checks. For each and every month, you're either earning nothing or anything up to $1,580. Now, the earnings test, unlike the yearly one, where any income over $18,960, you lose $1 or you forfeit $1 of your Social Security benefit for every 2 over the limit, okay? So it's an easy formula. It's 1/2. Whatever the amount of income over $18,960, divide in half, and that's what you're going to forfeit out of your Social Security checks. The monthly earnings test is different. It's not a 1 for 2. If there's 1 month you earn $1,581, you forfeit your entire check for that month, okay? So it's going to be, Social Security will use one test or the other. There's no combination in the first year of retirement. Every year after that, this monthly earnings test is out the window. So every month leading up to the year of full retirement age, they're going to be using that $18,960 or whatever the new amount's going to be for next year or the year after and so forth. Okay. Now, maybe I'm throwing out a lot of information. I'll tell you one thing, folks in the administration, it takes some people a long time to understand this whole process. So if you're feeling a little bewildered about it all, I'm not blaming you for that. I want to just give you a quick overview, all right? And you can do some more research behind this or get in touch with us at AMAC, and we can help you out with that. The year you turn full retirement age, again, based on the year of your birth, it's a little different if you decide to wait that year, okay, to start collecting, or going back to work, for instance. So, the months prior to your full retirement age, this year, you can earn up to, is it there? Oh, is it on another chart? Okay, so it's $50,520, okay? $50,520 this year for just a month before full retirement age. An individual can earn that, still receive all their checks, if they choose to. If not, you say, hey, look, I'm going to wait till my full retirement age month. I'm going to start then, get 100% of my benefits. Your choice. Remember, what we're talking about as far as Social Security benefits are concerned, when should I file, like Russ was saying, what the book says, but when's a good time to do this, okay? It's your personal choice. I could go around a room of 100 people, I'm going to get 100 different answers of what their personal choices are and what their decisions are, okay? So, the month you turn full retirement age, folks, no more limit to income. You can go back to work full time, sky's the limit, and still receive your Social Security checks. Now, taxation may come into the picture. We'll cover that later, all right? Another chart? Or is this it? Yes?
You might just want to mention that any benefits lost because you exceeded the earning.
Thank you. Thank you, Russ. Yes, that's a good point. Russ was just reminding me. So folks will contact, us, Social Security, and they say, okay, now you're telling me I filed for these benefits. You're telling me I'm going to go over the limit. I'm going to lose X amount of months of checks, okay? But yet, I actually applied for a reduced benefit. Now I'm locked in. And that's true. You are locked in, okay? Until after full retirement age. Actually, the year after you turn full retirement age. Social Security will do a look back. Their system automatically looks back, and they look and they say, okay, each year, how many months did we withhold of your benefits? And the year after your full retirement age, that adjustment is applied back to the month you turn full retirement age, and it boosts your Social Security benefits up. They don't pay you those checks back, okay? But instead, let's say over 3 years' worth, you've lost 12 months of checks. A couple of months 1 year, a couple of months another year, okay, and so forth. After your full retirement age, Social Security gives you credit back for those 12 months that you didn't collect. So instead of having applied at age 62, when you actually did, the system is going to say, oh, let's boost that retirement age to 63 instead, give you 12 months credit. So it increases your monthly benefit as if you had applied at age 63. All right, so it's not a permanent reduction if you're forfeiting some benefits, okay? Thanks, Russ, for reminding me, okay, because that's a common question, and we're getting it too, with some of our emails and calls. Anything else after this? Is there another chart? This is it? Oh my God, okay.
The line on that chart is important. Consider what you're planning to do in the future when you file for Social Security. Just keep that in mind, because it may affect your cash flow in retirement. Okay, now we're going to move into a topic that we get a lot of questions about, and we get calls from people that are upset, frustrated. But it's this issue of taxation of Social Security benefits. It's become a little bit of a political football, I would say, these days. In fact, there's an article out on the table that we produced that you might want to read about the dilemma of double taxation, which is the way a lot of people look at it. You've paid FICA tax all your working career, now you're drawing benefits, and all of a sudden it's taxable. And that really upsets people. So I'm going to ask Arlene to talk a little bit about how that happens.
Before 1984, benefits were tax exempt. That changed with laws that were passed in 1983 and 1993. Now, part of your benefits are taxable depending on what's called your modified adjusted gross income. If Social Security is your only income, then it's not taxable. If you have other incomes, such as earnings, pensions, 401ks, you could owe taxes on some of your benefits. Your modified adjusted gross income is determined by taking 50% of your benefit amount plus any non-taxable interest and adding it back to your adjusted gross income. So if we look at the chart, if you're a person who's filing single and your modified adjusted gross income is between 25,000 up to 50% of your Social Security benefits are taxable. If your income is 34,000, then you've reached the second level, and up to 85% of your benefits are taxable. If you're married filing jointly and your modified adjusted gross income is $32,000. You reach the first level, and up to 50% of your Social Security benefits are taxable. And if you reach $44,000, then you've reached the second level, and up to 85% of your Social Security benefits are going to be taxable. You can have income tax of 7, 10, 15, or 25% withheld from your Social Security benefits if you choose to. It is optional. And to do that, you can get the IRS Form W-4V from irs.gov or call 800-829-1040. You fill it out and you send it into your local Social Security office. And to determine your tax rate, you would want to speak to a tax professional to get input on your personal situation. We are not tax advisors, so this is general information just to give you some guidelines.
Married filing separately does not reduce your tax liability on your Social Security benefits. It would actually increase it, as then you become taxable on up to 50 or 85% of your benefits, starting with the first dollar you earn. So you can't get out of it that way. Sorry.
On that too, because when people find out that their modified adjusted gross income is going to bump them over the limit, they say, well, how about if we just file separately? You know what, the tax that you lose, the benefits that you lose filing jointly, I should say it the other way, the benefit that you gained filing jointly is far outweighs what you're going to be paying here.
And as I said, this is one of the topics that we get a lot of, not necessarily questions, as opposed to commentary about it, about how unfair it is and all that. And unfortunately, this is the way the system works. And it's being considered in Congress for perhaps changing the limits or perhaps not taxing Social Security. But with Social Security already facing a solvency issue, you have to remember taxation of benefits brings in quite a few billions of dollars of revenue. So unless there's a way to offset that, I don't think it's going to change personally. But I know there are bills in Congress to address it. So meantime, all we'll do is explain the way it works. So, okay, moving along to the complex area of disability. Disability is something that we spend a lot of time talking with people about, and I'm going to ask Eileen to get into some of the details.
I'm sorry. Okay, SSDI. Don't confuse it with SSI. SSDI is available to those who have a physical or mental condition that prevents them from engaging in any substantial gainful activity. And the amounts for substantial gainful activity for 2021 is $1,310 or more a month. If you're a blind individual, it's $2,190. You are under your full retirement age. Now, we do have a lot of questions that come in. I'm 62. Doctor said, I can't work anymore, but I can't go without money. So we tell them you can apply for your benefits and apply for disability at the same time. I hate this thing. So if you can collect your early retirement benefits until you win your disability case. When you win your disability case, they will go back and adjust those months up to your estimated full retirement age benefit. So you don't have to worry about it, but that is an option to you when you're under your full retirement age and you need the money, so you can do that. And then have sufficient Social Security work credits. Disability insurance is called an insurance for a reason. That means you had to have paid into it. So currently, it's 40 credits. Now, you need 40 credits, but you have to have worked the last 5 out of the 10 years, the year you became disabled. I mean, you can be out of, have the 40 credits, be under your full retirement age, but not have worked for the last 15 years and become disabled. I'm sorry, you're not going to be able to get SSDI. Okay? Now, one thing I tell people, and it's very important to tell people, is you need to apply for SSDI as soon as you become disabled. Do not wait. If your doctor says you're disabled, you're not going to be able to return to work maybe for another 2 years or anything over a year. Let's say it's going to be a long rehab session, or unfortunately you're going to pass. So this is when you apply. Don't wait, oh, maybe I'll wait for a year. Don't apply, because it will take 3 to 5 months at least, if not longer. And I can testify for my late husband, it was 2 years. A week before we went in front of the court judge was reviewing his case and told his lawyer, disability, go back 2 years. So that was very unusual, but it took 2 years for him to get disability. So it's a long time. And then there are times when it's compassionate allowance are available. Those are like 200 conditions that Social Security Administration has flagged as saying, let's give them SS benefits right away. And those are like the types of cancers, ALS, but there's also other, you cannot have those 200 conditions and you still be disabled and not be able to work. You can always ask for a quick disability determination, which is a computer-based program that the Social Security Administration uses. It's a model. It looks for on the application and identifies cases where there's favorable disability is highly likely with medical evidence readily available, and they'll expedite the case. So it's not all lost, but just in case. Now, if you're approved, there's a 5-month waiting period, and the payments are made within 6 months of the date of disability, except there's a new law for ALS, which was signed into law, is the ALS Disability Insurance Access Act, which eliminates the 5-month waiting period for individuals before they can receive SSDI and Medicare. So, and that unfortunately went into effect the end of December. There is some controversy about SSA is not retroing back, and they're reviewing it as, that day the bill was signed, but there is a movement in Congress and the lawmakers to get Social Security to recognize that, to go back the retro. So these people that have applied the ALS do not have to wait that 5 months. So, and then we have to talk about there is an option for spousal benefits. And just to know that you can get your spousal benefit as early as 62. You're not subject to deemed filing, and we'll discuss that next slide when we talk about spouses and ex-spouses. Yes, sir.
Can I add something real quick?
Go ahead.
Okay. One common thing about the Social Security Disability Program, quite often this is something that we would see, and they still see. You heard Eileen mention about the SGA, the Substantial Gainful Activity amount, that if you earn over that, you're not considered disabled. There's a lot of folks that may have been cut back on work because of illnesses. So you may have someone who's only earning $1,000 a month. You know what? They can still potentially qualify for benefits, okay? Even while earning that $1,000. So that SGA level is extremely important. And this year it's what, 1310? Okay. For blind individual. Okay, so keep that in mind. That individual may have gone from earning $5,000 a month and they're only earning $1,000, and the doctor said, look, you can't work full time for the rest of your life. That person should still be filing for disability. Thank you, Eileen.
No, we're on now. Oh, sorry. All right. Let's talk spouses, ex-spouses, and survivors. Spouses and ex-spouses collecting at 62 with a full retirement age of 66 will receive about 35% of the workers' PIA. Now, the next slide will give you a little breakdown of that. Ex-spouses must be married to the worker at least 10 years and not remarried. There is no spousal boost if your benefit of your own work record is greater. All right, a lot of people get confused with that. They say, well, I'm married, I can get 50% of his. Well, there's not much difference between yours and your husband's benefit, but they still think they should get 50% on top of that. No, it doesn't work that way. So just for like a little information, because I'm a geeky person like this. The spouse of retired workers as of January 2021, a little over 2.3 million beneficiaries, which is about 3.5% of Social Security beneficiaries that Social Security Administration pays out. So, and just a quirky little thing, children of retired workers, a little over 704,000, which represents 1.1% of the Social Security beneficiaries. So Social Security is paying for children of retired workers. So, now let's talk about deemed filing. I'm going to give you the definition of deemed filing, and then Sharon's going to talk to you in the next slide where old and new rules mean. So, deemed filing means that when you file either your retirement or your spouse's benefit, you are required or deemed to be filing for another benefit as well. Basically, you have no other option that if you apply for your retirement benefit, your husband is collecting, you automatically will get, if it's applicable, the spousal benefit as well. You can't do one or the other. You got to do both. And then we'll discuss that later. So let's move on to survivors. Surviving spouses at the full retirement age get 100% of workers' benefit if married 9 months or more. The surviving spouse gets 100% of the benefit, ex-spouse benefit if married 10 years or more. Both can collect reduced benefits at 60 or 50 if disabled, and can collect earlier if caring for a minor child of the deceased. Dependent minor children and dependent parents can also get benefits. Now, just geeky statistics again. Okay, survivor benefits as of January 2021, over 5.8 million, which totals about 9% of the beneficiaries that Social Security pays for. Children of deceased workers as of January 2021 is 1.9 million beneficiaries they pay, which equals to about 3%. And for dependent parents, there's 1,000. So that's as of January 2021. So if you don't think it's a small amount, but it does occur. So, and then one thing a lot of people get confused about, I know I talk very fast and I have an accent, so family maximum may apply. Let me give you the definition of family maximum. The maximum monthly amount that can be paid on a worker's earnings record. This does not apply to a married couple. For example, a worker, a spouse, and a dependent child in the household. That's when a family maximum will come into play. The family maximum will normally be between 150 to 188% of the worker's PIA amount. So the next slide, next slide, okay. Now there's the URL up there is for spousal, if you want to do a quick calculation of spousal benefits, but we should tell you this one is calculated if the other spouse does not qualify under their own work record. So, however, a working spouse can use this also. I'll give you a ballpark figure, but it's basically geared to the spouse not having qualified under their own thing. Now we were talking about spousal benefits and how it works. So we're doing the spouse's primary insurance amount of $2,500. 50% of that equals the maximum spousal benefit, which is $1,250. Now, let's say the other spouse's primary insurance amount is only $700. So the true spousal benefit is $550. I wish it was $5,550, but it's not. So this gives you a breakdown of when the spouse takes it at 62, 63, 64, 65, and then the full retirement is 66. So you see, they're not going to get that full spousal benefit until the full retirement age is 66. And that's important to remember, because I think a lot of people get confused by that. And it's also something that we should say. If you take your benefit at 62, it does not increase when you come to your full retirement age. A lot of people get confused about that. They don't realize it's a permanent reduction. Whenever you take your benefit early, it's permanent, that reduction. So that's it for me. Then it's
Sharon's gonna talk about this thing called the restricted application, which is something that is actually going away, and she's going to talk about that in terms of what it is. I should say what it was and what it is today, and how it's going away. Sharon.
Okay. The restricted application was a strategy for married couples that was passed in 2000. Now in 2015, it's now only available to people born January 1st, 1954 or before. What the restricted application for spousal benefits only allows is for one spouse to take their benefits and then the other spouse to file strictly for a spousal benefit and allow their own benefit to grow to the age of 70. And it usually was the case that the lower earning spouse would take their benefits sometimes early, because the higher earning spouse that wanted to increase his benefit to the maximum at age 70 would still receive 50% of the other spouse's full retirement age benefit. Then say if the lower earning spouse was going to be eligible for a spousal benefit, when the other spouse filed at 70, they would at that time, if born January 1st, 1954 or before, would then apply for their spousal benefit. If it's a spouse under the new rules, which means anyone born January 2nd, 1954 or later, is now subject to deemed filing. If the higher earning spouse that they're going to receive a spousal benefit on has already filed for their benefits, the second that other spouse applies, they don't have a choice. They will be deemed as filing for both their spousal and their own retirement benefit if they're eligible for one. And if they're taking it early, that's a combination of both your spousal and retirement benefit, and you take a permanent reduction that will only increase through the cost of living. Anyone that hasn't reached age 70 yet, that was born January 1st, 1954 or before, and has not started their benefits yet, are still eligible to use this strategy. I deal with a lot of spouses where they're both beyond their full retirement age. They haven't started their benefits. This puts them in the unique position where the lower earning spouse starts their benefit and the higher earning spouse files the restricted application, but they can actually each take 6 months retroactive benefits. One takes 6 months retroactive benefits on their own retirement benefit. The one that files, it will reduce their benefit by 4%. But a lot of times that spouse is actually eligible for a spousal benefit. So she's actually, or he, it could be either way, because sometimes, they're actually reducing that spousal benefit they're going to receive when that higher income spouse applies. And the spouse that's filing the restricted application takes the full 50% of the other spouse's benefit in 6 months retroactive benefits. And these can wind up in a pretty nice lump sum payment. But it is going away. But if you're born before January 1st, 1954 and still not taking benefits, It's something you might want to check into, and you can always feel free to call us. Oh, and there was another unique thing that I actually helped some people. Divorced spouses that have both reached their full retirement age but have not yet started their benefits can actually file a restricted application on each other, and they're the only ones that are allowed to do that as long as they've been divorced at least 2 years.
Okay, thank you, Sharon. Shift gears a little bit, and we'll talk about the cost of living adjustment, the annual cost of living adjustment that's applied to Social Security benefits. It's another topic that we get a lot of questions about, especially at the beginning of the year. You know, when the January benefits are paid out, people question, you know, sometimes why didn't they get what the cost of living adjustment was supposed to be, and we'll talk a little bit about that in a moment. But this is the way the cost of living adjustment calculation takes place. It's done based on the Consumer Price Index for urban wage earners and clerical workers. That's the technical name of CPIW. And basically what they do is they study the spending habits of people that fall into that category, and they basically calculate how much they spend on various types of goods, and they measure those spending patterns for 3 months of the year. It's the third quarter of the year, July, August, and September. And they calculate what the total spending level is and create an index with that. Compare that to the same 3 months from the preceding year and divide the two. And if it's a positive number, that becomes the COLA for the following year. So that's mathematically the way that it's done. And if the current year calculation is less than the previous year, then COLA is set at 0. It never goes down. The cost of living adjustment for 2021 that we mentioned earlier was 1.3%. It was 1.6% of the preceding year. And we have no idea, based on the economy right now, what it's going to be next year. We won't know that until October of this year. But that's mathematically the way that it works. And this is a chart basically just to show you the history of COLA through the years. It started in 1975, and you see it's been up and down. There have been some really high inflation years. It's really an inflation measurement is what COLA actually is. And you see that in the 1980, 79, 80, 81 period, there were some really high years. You may remember reading about Social Security adjustments of being 8, 9, 10%. Those days are gone, and I guess that's a good thing because that says that inflation is not nearly what it was back then, which in many respects is a good thing. But if you look at the total period from 1975 to 2020, the average cost of living adjustment was 3.6% across that entire period of time. And this year, as I said, it was 1.3. For the past 10 years, the average was 1.7. So it's been a pretty steady cost of living adjustment. There have been some 0 years, as some of you may know. 2009, 10, and 15, I think it was. The calculation produced no cost of living adjustment. That's why the 10-year number is actually so low. I mentioned earlier that we get a lot of questions in January from people that they have done their calculation and they suspected that they expected a 1.3% cost of living adjustment, and we'll get the phone calls like, I didn't get that much. I got my check and it's not that much. Well, the difference is the way Social Security does that is your Part B premium for Medicare is deducted from that. And so that's why the 1.3 really doesn't materialize in the benefit checks. And we get a lot of questions about that. So we just wanted to throw that in because it is a topic that we get a lot of questions about, cost of living adjustments. So With that, we're going to move on to maximum taxable earnings.
I think I actually covered this in the
And that's
beginning.
sure.
I got ahead of myself. As I mentioned previously, the maximum taxable earnings in 2021 are $142,800. That's where your Social Security payroll tax cap puts on, and it's also what determines what your Social Security benefits calculated on. Now, it is determined by the changes to the National Wage Index. And if you ever want to try to do it on your own, there's the calculation of how they determine what it's going to be. And that's just to let you see where they get there. And if there's changes are only happen if there is COLA. If there's no cost of living increase, there will not be an increase in the wage base. And someone that is paying maximum Social Security tax this year in 2021 is paying $8,853.60. They're paying $316.20 more than 2020.
Okay.
Eileen likes working with numbers. And so,
well, I do have I'm a geek, I admit, when it comes to numbers, but don't ask me to program your phone. So I have enough problems. So I want to discuss Social Security benefits by the numbers and how important, and I know Ken has said it, Russ has said it, we've all said it at this table, Jerry has said it's how important Social Security is. Now you can see the maximum benefit amount, which at full retirement age this year is $3,148. At age 70 is $3,895. The average benefit of retiree is $1,546, and the retired couple is $2,596. Now I want to point out the little long box underneath that. That's where we always stress how important Social Security is. 50% of couples and 70% of singles rely on Social Security for 50% of their income. Now, the sad part after that is 21% of couples and 45% of singles rely on Social Security for 90% of their income. It cannot stress how important Social Security is. Now, both Jerry has said it's a mean tested and the progressive part of Social Security. Now, I'm going to read you something because I like numbers. So, to explain what progressive Social Security benefits, they represent a higher proportion of the worker's previous earnings for workers at a lower earning levels. For example, benefits for lower earning, which is 45% of the average wage, which Sharon was discussing, retiring at 65 in 2020, replaced half of their prior earnings. But benefits for higher earner, which is 160% of the average wage, replaces about 1/4 of their prior earnings. Though they receive a larger dollar amount in their benefits than those of the lower wage. You can see by the graph, you can see the low end, which what they receive and what their earnings were. So this is what they mean by progressive. Social Security benefits are progressive. And it is also a means testing, which, we always advise people. So anyway, that's it for my spiel.
okay, this is the area coming up now that we're not going to talk a whole lot about in terms of real detail. It does not apply to everybody, but there are people perhaps watching this broadcast that it does apply to. So we're going to touch on it. And again, if you have specific questions, you can contact us at our advisory service. So Sharon, give us an overview.
Yeah, I'm going to give you an overview on the windfall elimination provision known as WEP. Jerry calls it WEEP. And then also the government pension offset. These tend to affect a lot of state and local government workers that work in systems such as teachers, police officers, firefighters, They work in positions that do not pay into the Social Security system, and they're part of a government pension. What happens then is in 1983, the government decided their Social Security benefits needed to be offset. So, but there's so many things that can affect it. The Social Security statements, your earning statements, they do not account for this reduction. They're simply going to show you your full estimate. Where you notice it on your earning statements is if you look under the Social Security column, you're going to have a bunch of zeros in one column, but you're going to have all your earnings in the Medicare column. Now, none of those years are going to count into your Social Security calculation. Yeah. Okay, and when someone is subject to WEP, and it goes beyond, it's not just their own benefit being affected. When a person's primary insurance amount, which is what's usually equal to your full retirement age benefit, gets reduced by WEP, it's also going to reduce any spousal or dependent benefits because their benefits are going to be based on your WEP reduced benefit. The good news is, though, when the higher earning spouse, say, is the one that's subject to WEP, that WEP reduction goes away completely if the other spouse is a surviving spouse. They will receive 100% of that benefit with no WEP reduction, even if they're entitled to their government pension. They will actually take the primary insurance amount and recalculate all the COLA increases onto the primary insurance and bring it forward to the date of death. And if the surviving spouse has reached their full retirement age, they'll receive 100% of that benefit. And there's a couple ways to avoid the WEP reduction. One, you can forfeit your government pension. Simply take out the amount you paid in plus the interest you paid on the amount you paid in. Most people don't want to do that. The other option is you can work your way out of the WEP reduction. There is a special chart called with substantial earnings that if you earn that much on each year, you can actually work your way out of WEP. You simply would take your earnings statement and compare it against the substantial earnings. And if your earnings are higher than the amount on that chart, for each year you go beyond 20 years of substantial earnings. As you can see, it reduces that WEP reduction until you can actually work your way right out of it. The maximum reduction for someone turning 62 in 2021 is $498. Now that amount stays with you regardless whether you start your benefits at 62 or you start your benefits at 70. One thing about starting your benefits at 70 when you're subject to WEP, you will notice that it actually increases your WEP reduction. When you start it at 62, it actually decreases the WEP reduction. And if you continue working beyond your full retirement age, until you start your until you retire from that position and become eligible for that pension, you're not subject to WEP. So say you reach your full retirement age, you can take your Social Security benefits, you continue working in that position as you're not subject to WEP, as you're not cannot receive your pension at that time. You'll get 100% of your benefits until you retire, then the WEP reduction will kick in. And then This link that you see here is a WEP calculator. If you want to try to determine what your WEP reduction is going to be if you're affected by it, you can use that calculator on the Social Security website. And enough on WEP. Let's go to the government. Well, okay, we've got more on WEP. Okay, what this is, like when Russ explained the formula to calculate your AIM, they use the first 90% of your first $996, and you got the next two bend points. Well, when someone's subject to WEP, say they have the less than 20 years, they will only use the first 40% of the first $996. The next two bend points aren't affected whatsoever. And if your pension is smaller than your Social Security benefit can never be reduced by more than 50% of your pension. WEP can never zero out your Social Security benefit, unlike the government pension offset. Now, the government pension offset is what affects someone that worked in non-covered employments, their spousal benefit, and their survivor benefit. This one can be way more severe because it can actually zero out any benefits you're eligible for on your husband's record, because what Social Security is going to do is they are going to look at your gross government pension, no allowance for deductions. They're going to multiply it times 2/3, $2 for every $3, or times 0.667, and they're going to take 2/3 of your gross government pension, and they're going to deduct it from any spousal or survivor benefit you're eligible for. And like I said, that one can actually zero out those benefits. You can also work your way out of the government pension offset. You can take a job back in the system, work at least 1 day a month. You have to do this for 5 years. You cannot collect your pension during this time, but as long as you don't work so much as 1 day in a position that doesn't pay into Social Security, which would zero out that month, in 5 years, you can actually get rid of the government pension offset and receive your full spousal or survivor benefit. And then there are mixed earnings and everything else that affects this. So that's why I said we're really not going to go into it. Anyone affected, please feel free to contact us.
And similar to the taxation of benefits issues, there were bills active last year or in the last Congress to eliminate WEP and GPO. They didn't go anywhere. They'll probably be reintroduced this year. I don't think they'll go anywhere this year either, but there is government attention being focused on the potential elimination of WEP and GPO. So, okay. Getting near the end here, we'd like to close with some discussion on the intersection of Medicare and Social Security. There's some important things that people need to be aware of. And Eileen is our resident Medicare healthcare expert. So,
okay, let's discuss Medicare. Medicare for 2021, as you know, the standard Part B premium is $148.50. The Part A deductible is $14.84, and Part B deductible is $203. There's one question I think on the top 5 that we get is, do I need to take Medicare at 65? It all depends. If you are working, it depends on how many employees there are in the company. If you have less than 20 employees, you should take your Medicare when you become 65 because your Medicare will be primary, your other insurance will be secondary. And if you don't, it gets reported, it gets a mess. So now, if your employer has over 20 employees, you should ask your benefit manager whether you have a group health plan coverage that is defined by the IRS. IRS has got their hands into everything. They will determine if your group health care coverage is technically group health care coverage. So this is what happens. You should always ask your benefit manager. There are some, hopefully your benefit manager is educated in that area, but if not, if you're confused, you can always call us or drop us an email and we'll explain the difference, the 20 or over 20. Now, you can, if you're in that situation, you have over 20, if you want to delay both A and B coverage, you don't have to do it until, after you're 65. Your Part A coverage will go back. However, your Part A coverage will go retro back 6 months from when you sign up, but no earlier than the first month you became eligible for Medicare. Now, keep that in the back of your mind. To avoid it, if you have a health savings account, to avoid a tax penalty, you should stop contributing to your health savings account at least 6 months before you apply for Medicare. If you know come July 1st that you're retiring, you're 67, you're retiring, and you have a health savings account, stop it. Don't contribute from January to June, okay? Because what happens is you're going to get hit with a tax penalty, and it's not nice. Personally, I don't like to pay more than I have to, so I don't know about you guys, but I know. So if you are not eligible for a free Part A and you don't take it when you're eligible, you may have to pay a penalty. Luckily, it's only 2 years for every year that you missed. So when let's say your employment ends or your union coverage ends, what happens? You have 8 months to sign up for Part A without a penalty. Whether or not you choose COBRA, if you choose COBRA, don't wait till the end of the 8th month, because I recently had a woman call and crying because she missed out because something happened with her. She couldn't sign up. She was locked out of her account. She was waiting until the last possible day to sign up. She got locked out. She couldn't apply. Well, she could apply, but they're going to deny it. And then what happens is you're going to have to wait to general enrollment period, which is January 1st to March 31st, and your coverage will not start to July 1st. And you also could end up being Part B penalty, Part D penalty, and that is permanent. That is till the day you die, you will be paying that penalty. So not something that's I stress very, as they know, I go a little crazy on this stuff because arguing with Medicare is take my word for it. I did it for 30 plus years. So if you already have COBRA coverage when you enroll in Medicare, your COBRA coverage will probably end. If you become eligible for COBRA coverage after you're already enrolled in Medicare, you must be allowed to take COBRA coverage. That's the law. It will always be secondary to Medicare. Some people like to keep it if they're going for an operation because their health coverage will pick up what Medicare doesn't pay. But that's your choice. But just to let you know, that is the law. So let's go on to this. This is another area we receive a lot of information on, a lot of questions on. IRMA, Income-Related Monthly Adjustment Amount, aka IRMA. IRMA is not your friend. So it's based on 2 years prior. So this year you're paying off what your earnings were in 2019. So as you can tell, your taxes, if you're individual, up to $88,000, you're going to pay your standard $148.50, and whatever your Part D premium is for your plan. And as it goes up, you'll see that the your premium for B and D increases. Now, Social Security understands there are times something happens. It's called life-changing event. Death of a spouse, marriage, divorce, annulment, you stop working, your spouse stops working, involuntary. Now, that's the big word, is involuntary. Not voluntarily selling your property, rental property, but involuntarily selling, income-producing property due to a national disaster, fraud, or other circumstances. The loss of your pension. Let's say your pension fund, something happens, it goes bankrupt. That's another issue. And then the receipt of settlement of payment from a current or former employer due to the employer's closure or bankruptcy. I expect in 2 years to see a lot of this coming up because a lot of companies went belly up during COVID. So I hate to use that word, but went bankrupt during and could affect their pension plan as they go through the bankruptcy court. The pension plan gets pulled in as well. So I expect in 2 years' time to see a lot of that. So also, if you filed an amended tax return with the IRS, now I'm going to tell you, and then if there is an error in the IRS data, if they're using an out-of-date tax return, you can ask them to redo the initial determination because they're using an outdated tax return. Let's say they're using 2018 instead of 2019. It could be. So you can do that. Now you can ask a new determination. There's a whole appeal process, and each time you'll get something from saying, we're denying this. It will tell you how to appeal. Do not wait till the last minute to do these appeals because if you don't do it in 60 days, they don't want to hear it. So the minute you get it, appeal it. If you want to appeal it, don't wait because they don't care. They don't want to care if it's a snowstorm. They don't want to care that your regular mail carrier was out and you had a substitute. They don't care. So just to let you know that. I get a little crazy on this stuff as they're used to me, but because once you get into that situation, like I said, they are cutoff date and they're not going to look back unless you can prove that there was a signed receipt from that department. They don't care. So, like I said, do not wait till the last minute to do this stuff. So you can do that. You can submit a Medicare life-changing event form, or you can call up Social Security and ask for either an over-phone appointment, but you're going to have to do the documents. And I also want to get back to one thing when I said about the amended tax return and also the life-changing amendment. Because the person had not filed their taxes yet, they did an estimated amount. They were fine. Medicare said, okay, fine, we'll go back to, lower to $148.50. Well, when IRS sent Social Security their form, they had underestimated $80,000. So guess what? They went back, and they will go back. So when it's estimated, it's estimated. So they also say in that form, if they find that you have underestimated, they will go back and adjust. And they all called up crying because they're losing their check because they owe these Medicare back premiums. So you don't see, I'm just doing estimated. I'm just going to, underestimate, a couple of thousand or something like that. These couple estimated under $80,000, and then they catches up to you. So it happens. I've had another one that said they filed their tax returns 2 years earlier. They sent in an amended one, which actually lowered their modified adjusted gross income. I said, well, call them up and tell them that have your forms. You have your transcript from the IRS saying they accepted your amended return, and they will adjust. So it goes either way on that thing. So, but that's my spiel on Medicare and the premiums and everything else.
One minor detail I want to add to, for example, a situation where somebody has retired and is not drawing Social Security and reaches age 65 and signs up for Medicare, they do not have to file for Social Security at that point. We have encountered that with people that thought that was the case. Because if your full retirement age is 67 and you file at 65 because you think you have to, you're going to take a reduction in your Social Security benefits. So just wanted to make that point. So, and that's a real life example that we have had. So that concludes our material for today. Again, I want to thank everybody for being here, and for those that are watching us remotely, thank you as well. I would ask you also to keep an eye out on our emacfoundation.org website for upcoming events, and also for veterans. I should have mentioned this earlier, but for veterans, we recently expanded our website to include a For Veterans page, and we have a pretty extensive repository of resources, programs, information that's applicable to veterans, and it's keyword searchable. And it's something that the foundation, in conjunction with AMAC, has embarked on, called the Veterans 2021 Initiative, and we're really expanding our support of the veterans community. So that was a major upgrade to our website earlier, actually late last year. So I would encourage you to take a look at that. Also, our Social Security Advisory Service, as I mentioned earlier, is available free to the public. Feel free to contact us if you have any questions or if you need any information, or if you just want to know what to do next. We take email inquiries, we take telephone inquiries, and walk-ins if you happen to be in the area. So please stop in and see us, and we turn them around pretty quickly. And as I said, we're well over 15,000 that we've served so far, and it's continuing to grow. So please contact us. And to stay current on both Social Security, retirement issues, and Medicare and healthcare issues, check out our websites, socialsecurity.report.org and medicarereport.org. A lot of valuable and current information on there, and they're updated 5 days a week. So with that, I will conclude, and I want to say thank you to my colleagues, and it's been a pleasure working with you again on this. And we will do these briefings periodically. This one we do annually, but we do a lot of other briefings throughout the year. So with that, I will just say one more time, thank you.